Hello everyone, welcome to your own channel Daily Commodity. So today's topic is related to trading of a commodity which is an edible legume native to Asia, and it is an important source of protein in many modern diets, that is the commodity soybean. Today soybeans, soybean oil and soybean meals are important commodity in global market. Soybean plant grows in any climate with a warm growing season and ample water and sunlight. Farmers plant seeds in row and in 4 to 7 days they sprout into plants. The planting season is between May and July, and the harvesting occurs around September and when the crop has fully matured. Soybean grows in a very similar condition to the corn. In today's video, we are going to discuss about why should you invest in soybean and how to trade in soybean futures, options, ETF and CFDs. So let me remind you, if you have not subscribed to our channel yet, please do subscribe to our channel and press the bell icon to get all the notifications and updates from Daily Commodity. So let us begin. Why should you trade in soybean? Investors purchase agricultural commodities such as soybean for a variety of reasons, but here are the main three reasons. First, inflation and weak US dollar hedge. The second is bet on demand growth. And the third is portfolio diversification. First, inflation and weak US dollar hedge. Soybean are a way to bet on the weak US dollar and a higher inflation. Since the agricultural commodities such as soybean are priced in the US dollar, the performance of the world's largest economy plays a crucial role in the pricing of the commodity like soybean. Easy money policy from the US Federal Reserve Bank has kept the US dollar weak. Furthermore, US central bankers are likely to continue this policy to support the consumers' borrowing and spending. A weak dollar could stoke inflation concern and bolster the soybean prices. The second is bet on demand growth. Soybean are likely to be a big beneficiary of strong global growth, especially in the emerging market economy. Their demand for livestock feeds and in oil will probably grow as the developing world becomes richer. Demand in the developed world may also outstrip supply in the coming years, and the factors such as growth in biodiesel could contribute to this demand. Diversifying your portfolio. Most investors have has vast majority of their asset in the stock and bonds. Commodities such as soybean provides investor another way to diversify and reduce the overall risk of their portfolio. Should you invest in soybean? Investor who wants exposure to soybean should consider buying a basket of commodity that includes other agricultural staples such as wheat, corn, barley and sugar. For the true diversification, they should also add the metals and energies as well. Purchasing a basket of a commodity helps to protect the investor from the volatility of individual commodity. It also adds overall diversification to portfolio investment. How can you invest in soybean? Soybean investors have several ways to invest in commodities such as futures, option, ETF and CFDs. So now let us know how to trade soybean future. Soybean future. The Chicago Mercantile Exchange trades a soybean future contract. The soybean future contract settles into 5,000 bushels or 136 metric tons of soybean. The CME contract trades globally on CME Globex electronic traded platform and has the expiration date of the month January, March, May, July, August, September and November. Futures are a derivative instrument which allows the investor to make leverage bet on the commodity prices. If the price declines, then the trader must pay the deposit additional margin in order to maintain their position in the market. At the expiration, investor must either accept the physical delivery of the soybean or roll their position forward to the next trading month. Investing in futures requires a high level of sophistication since the factors such as storage cost and interest rates affects the pricing. How to trade in soybean option on future. The CME also offers an option contract on the soybean future contract. Options are also a derivative instrument that employs leverage to invest in the commodities. As with the future option, has an expiration date. However, the option also has a strike price, which is the price which is above the option finishes in the money. Option buyers pays a price known as a premium at the time of purchasing a contract. An option bet succeeds only if the price of the soybean future rises, which is above the strike price, by an amount which should be greater than the premium paid for the contract. Therefore, the option traders must be right about the size and the timing in move in soybean futures to profit their trades. How to trade in soybean ETF. ETF are nothing but the exchange traded fund. These financial instrument trades as the share on exchange in the same way as stock does. Currently, only one ETF, Tucrium Soybean Fund, offers a pure play on soybean investing. The fund invests in the soybean future contracts. One, o- One another way you can invest in soybean is through the shares of soybean company. There are no play public companies exchange engage exclusively in the production and the sales of soybean. However, there are many large agribusiness that provides products such as fertilizers, pesticides and seeds to soybean producers. How to trade in soybean CFDs. CFDs are contract for difference. One way to invest in soybean is through the use of the contract for difference, which is again a derivative instrument. CFD allows investor to speculate on the price of the soybean. The value of the CFD is the difference between the price of the soybean at the time of the purchase and the current price. CFD traders are opens an account with a regulated broker and deposits the fund. The fund serves as the margin against the change in the value of the CFD. Many regulated brokers worldwide offer CFD on soybean. The advantage of CFD is that the trader can have the exposure to the soybean price without having purchasing the shares, ETF, futures, or options. Investing in CFD does not require the trader to pay for soybean storage or roll future contracts forward every month. Trader also don't have to worry about getting the timing and size of the market move correct in order to profit their trades. CFD are still high risk financial instrument. However, your capital is at risk. There are various uses of soybean such as soybean oil, soybean meal and miscellaneous uses. Soybean meal that remains after the oil extraction can be toasted and prepared as the animal feed for the poultry, pigs, cattle and other farm animals. If you want to invest in soybean, you can invest through soybean futures, option, ETF or CFDs. If you like the video, please do like, comment, share. Thank you.